So thank you for the opportunity. So Strategy navigated the 2022 bear market successfully. And so my question is going to relate to stress testing as it relates to these midterm BTC ratings. Given the strategy's credit products are backed more by assets and capital access than operating cash flows, are there certain Bitcoin bear market assumptions or thresholds, either such as in terms of drawdown magnitudes or lengths of time where capital markets might become inconducive for new capital issuance, that you're planning for as you design these forward leverage ratios and for your overall capital structure? Thank you.
I think that if we equitize the convertible bonds and we go to all preferreds, you can imagine, for example, you have $100 billion of Bitcoin, you have $50 billion of preferred in an extreme, like the extreme case, a 50% leverage case. And if that $50 billion was a debt liability coming due in 3 years, that would be a lot of risk. And if it was a debt liability coming due in 25 years, it'd be less risk, but it'd still be something. But if it's actually equity, if it's $50 billion preferred equity, it never comes due. And so now you have a different kind of risk. In that particular case, Bitcoin can draw down 80% and you're fine. It can draw down 90%. So I actually think if you look at our structure, as we migrate to preferreds, we end up with this, very, very robust anti-fragile capital structure where the principal never comes due. And then you have to ask the question, well, where is the liability? And the liability is in the dividend. You notice when Andrew showed the liabilities, he showed you 3 tranches. He showed you the interest liability, the cumulative liabilities, and the non-cumulative liabilities. That's because the interest has got to be paid or you're in default. The cumulative doesn't have to be paid, but if you suspend it, it accumulates, so it's still a liability. And then the non-cumulative, you could suspend it and it isn't a liability. So when you add all that up, you imagine that you've got $50 billion and you have, even if you had a 10% dividend, that means you're down to $5 billion. So on $100 billion of assets, you've got $5 billion of dividend liabilities, but some of them are more collapsible than others of them. But so you say to yourself, well, what happens if Bitcoin falls 95%? You'd still meet those liabilities most likely. You might in a 95% drawdown, you might suspend something. But you can see, for the most part, no one really contemplates, more than the 80% extreme craze case of the crypto. I guess the crypto winner is like 75% or something. You would know 6,000 to 16,000. I guess was like the peak to trough. Call it 80%. I think that our structure is smooth, and we wouldn't miss a single dividend payment on an 80% drawdown. On a 90% to 95% drawdown, in theory, you might suspend something for a little bit of time, but you would eventually get back current on it. So, so I think in terms of robustness, it's pretty robust. And if you compare it to the fragility of a conventional bank, think about the leverage we've got in order to generate our earnings. We've got maybe 1.2 leverage. A typical bank's got 10, 20x leverage to get their earnings. So this model is orders of magnitude less risky than a conventional banking model. Fong, Andrew, do you guys have anything to add on that?
I can add, Lynn. We've had the benefit of being a Bitcoin treasury company for 5 years. We went through a crypto winter in 2022 with a much more fragile debt structure and capital structure. We had a Silvergate margin loan that was Bitcoin backed. We had a secured note that had onerous clauses, and so we learned a lot from that. And at that point in time, our most pristine debt were our convertible notes. And now I think we're much more prepared for Bitcoin drawdown, because over time we already don't have secured notes. We don't have a margin loan. over time, we may not have convertible notes. And to Mike's point, we will be relying on perpetual preferred notes that don't ever come due. So I think we learned a lot during this period of time, and we hope to share that with everybody out there.
Thank you.
And of course, the point is we did survive the 80% drawdown with a much weaker capital structure. So this capital structure is bulletproof compared to that one. So I think we're good to 90%. And if it goes below 90%, then we'll shuffle a few things around. It'll be colorful.
Great.